Hi, this is Morgan Smith, certified financial planning professional and partner advisor with WorthPoint. We're a investment advisor, work with families and business owners across the country. And I'm here with my special guest, Nate DeLong, certified pension consultant with Future Plan. Nate, how you doing today?
I'm doing very well, Morgan. I'm excited to be here.
Well, good. Today's topic is really talking about the difference between a 401k and cash balance plans. How are they different? Why are we doing this? Well, I think a lot of folks out there are thinking about implementing a cash balance plan, and it's always good. They're trying to understand it. Like a lot of folks going, "Hey, what is it?" And it's always good when you're explaining things to have a good reference point. And I think most people are familiar with 401ks. And so we'll talk about cash balance plans utilizing the 401ks as a reference point for us. So, with that, let's get into it. So, the first thing we're going to look at is the classification. A 401k is a defined contribution plan. A cash balance plan, as opposed to a 401k, is actually a defined benefit plan. So let me talk a little bit about what those are and what the difference is. So you're most likely with any investment account, it's not just a 401k, but what you're doing is you're contributing the amount that you want uh, up to any constraints, and then you're adjusting your investment risk return characteristics to whatever you feel is appropriate. But you're not really the outcome. There could be a wide range of outcome, and so you're not really saying, okay, here's the end game, here's my goal. I want to make sure that everything is driving exactly towards that goal. You're basically defining the amount you can contribute, but the outcomes are going to be somewhat wider range and variable, as opposed to a cash balance plan, which is a defined benefit plan. And one, I guess, reference that people could use is a pension plan. So, pension plans for cities and some companies and governments, you're saying, okay, we're going to define what the benefit is going to be for you. And this is how much it can be based on your age and time and service and things like that. So it seems like maybe a very small difference, but it's a very big deal when it comes to how you manage the plan, the testing that goes into that from a actuarial standpoint, and actually developing the investment strategy. So I'll pause there. Nate, what would you like to expand on with the classification?
I think you did a great job. Most folks are familiar with the 401k, and that's kind of paycheck to paycheck, right? You're making your own contributions, determining how much you can save, and you determine what your retirement amount will be based on your risk tolerance, investments, how much you can afford to save, etc. Where on the other side of the coin is that defined benefit plan, and we'll define what your benefit will be at some future date, and then you'll fund that defined benefit plan each year to kind of hit that target. Some folks are familiar with defined benefit plans, and you know they're probably thinking, okay, at some point I'm going to get some monthly check in the mail once I retire, and that's not really how our defined benefit plans work. We don't force you to annuitize. We allow for a lump sum distribution. So as you save in the defined benefit plan every year, once you get to retirement, instead of annuitizing and taking a monthly benefit, you take the lump sum cash amount and you roll it to an IRA. And then when you work with Morgan, an advisor, on what to do with the cash that you've accumulated for retirement.
Great. So really, I mean, in summary, the overview, the takeaway from this is with a 401k, you've got the contribution amounts defined, and it's as simple as that. In a cash balance plan, basically, you're you're going to the end game, defining the benefit and walking it backwards to today, and figuring out what can be contributed and things like that. So it's a little reverse engineering, and again, it takes a lot more expertise, but something that's different that I wanted to highlight in this video. Max contribution. Wow. This is kind of a big deal here. And I think, well, let's just look at it with a 401k. You've got the employee max deferral in 2023 at 22,500, max contribution employee and employer at $66,000 per year. So a lot of folks think, God, that's great. $66,000 a year I can put away pre-tax, and that's good for me. But it doesn't even compare to how much you can put away in a cash balance plan. It really depends on your age, but if you combine it with a 401k and integrate these cash balance plans with 401ks, you can potentially get up to about $470,000 a year saved. Again, depending on your age. Now, the thing to remember is this isn't your ability to contribute pre-tax, but remember, this is money that you're going to be able to take out of your income and thus save that amount of taxes as well based on your tax rates, federal and state. So that's a big difference.
Yeah, absolutely. I kind of think of it almost like the Cinderella story. Which shoe is going to fit? And for some individuals, and IRA saving at $6,000 to $7,000 a year, more than appropriate. For other individuals, $50,000 to $60,000 a year might be great. But as your business is growing, you're making more money, you're becoming more profitable, saving at that rate, you're just not getting the mileage out of it at $70,000 a year, $60,000 to $70,000 a year. And that's where the cash balance plan enters, because it's going to allow a business owner to put away six-figure contributions every year and really accelerate their retirement savings. And again, all contributions to the plan are tax deductible for the business. So let's shelter some of those hard-earned profits from paying taxes. And instead of writing a check to pay taxes, let's write a check to the business owner, put it into an account with their name on it, invest in investments that are going to grow tax deferred as opposed to buying depreciating assets. So it's a great way to get the tax deduction that a lot of business owners are looking for and really accelerate retirement savings at the same time.
All right, we're going to look at contributions. And so you as a business owner, you're looking, maybe you've got a 401k plan, and as you know, maybe you're not doing profit sharing, or you don't have matches and matching, and the employees are just saving what they save, you being an employee as well. So the difference you need to be cognizant of in a cash balance plan, it's only employer contributions. And so the first question for most employers is, well, if I'm only contributing, what's the value? What's the benefit? So that's where what you really want to do up front is get an analysis. You get a census on who's making what, how old they are, how long they've been working for you. And I work with, say, for example, Future Plan, and we get to a presentation with you, and Future Plan will really look at it and say, okay, here's the benefit versus the cost. And it's up to the employer to say, okay, well, geez, yeah, it's not worth it to me, or it is worth it to me. I guess with the, I guess there's been a big increase in the amount of cash balance plans put into place. I guess a lot of employers are finding a lot of value there, even though they're making all the contributions. I mean, something must be going right. Right, Nate?
Yeah, absolutely. It's really, I kind of refer to it as more of a tax play than a retirement play, but it's a great way to save for retirement and take very large tax deductions along the way for the business owner.
Good. So another difference between a 401k plan is that the accounts in a 401k plan are separate. Every participant has their own account, and they can kind of invest how they want to, sometimes with some constraints. And the difference with a cash balance plan, it's one pooled account. And you as an employer would work with an appropriate investment advisor and And that's one of the things that I do is working with cash balance plans and their owners to come up with an investment strategy. So it's different. And again, a higher level of expertise needed, not only from an actuarial standpoint with, say, future plan, making sure that the accounting is precisely correct for each participant in the plan, and also from an investment standpoint, running a pooled account as opposed to these separate um, accounts. Nate, anything else to expand on with that?
No, I guess, in the 401k, you determine your own outcome. Everybody gets their own individual separate account. They manage their own money. Cash balance plans a pooled account. The business owner works with, Morgan, yourself, and you manage the money as a pool towards a specific rate of return.
Good. The next point is investment strategy. And I think many of us have heard about this idea of risk return. And, you look at your investment account and look at the goals of the account, the time horizon, uh, your personal tolerance for risk and other factors, and, you invest accordingly. Well, if you're using that strategy to invest in your cash balance plan, I would suggest that you're doing things wrong, and there could be a lot of risk that you're opening up yourself to with the cash balance plan. Cash balance plans, the investment strategy is significantly different. And the way I think about it is you've got this interest credit rate, and what Nate, typically you're seeing that at 4 to 5% a year. That the cash balance plan is going to be credited to increase every year, and you want to really get the investment return around that interest credit rate, and as closely as possible. You're not going to hit it exactly every year, but we want to reduce the volatility around the interest credit rate. And it's just a much different investment strategy. It takes a different level of expertise than most people are used to. Thoughts on that, Nate?
You're right. It's the rate of return, the interest crediting rate is written into the plan document and the actuarial formula. So the target each year is to hit that rate of return. And if we can hit that rate of return, we know with a certain degree of certainty what the annual contribution amount is going to be. Because again, these are required contributions each year. Although there are some levers we can pull if the business has a bad year or an off year, I should say. And so we're going to manage it toward that specific rate of return, and that's going to create certainty, or a certain amount of certainty, in the annual funding requirement. And most business owners and CPAs I work with, these are large contributions. They like to be able to budget that amount and know, okay, there's not going to be a wide degree of fluctuation because we're not up 30% one year and down 10% the next year.
Yes. Surprises on investment returns on both ends of the spectrum aren't necessarily good. So, for example, if you've got a year where investments have done incredibly well, what are you doing? Well, you're reducing the amount of runway, the amount of years that you can actually defer and get some tax savings. So that's not necessarily a good thing. You want to be able to have as many years as you can potentially to have this tax savings as long as you want it. On the flip side of the coin, if investments do really bad on a down year, then the owner might have to reach into the pocket and contribute for that year. Like you said, there's some flexibility there, but bottom line is the takeaway here is we want to minimize the volatility around their interest credit rate. And it's a lot different investment strategy than you would see with a 401k or any other account, and thus needs a higher level of expertise and experience. Fees, 401k, look, they're lower. There's no question about it. With a cash balance plan, the fees are higher. Again, I think it is what it is. There's a lot more moving parts, and we got to make sure that we keep people within compliance. And Nate, I'll let you speak on that a little more, because future plan is going to be really the focus when it comes to the actuarial expertise and keeping things within compliance?
Yeah, absolutely. The simple answer is cash balance plans, defined benefit plans need an actuary to draft the document, an actuary to sign off on the additional tax reporting forms that go to the IRS to run the actuarial numbers. So we need an actuary, so the costs are a little bit higher. Absolutely. Typically, the tax deductions, the tax savings are going to far outweigh any additional fees associated with the cash balance.
Right. And, I think many people will be familiar with 401k plans and working with a TPA or what's known as a third party administrator. And oftentimes they're looking at, what to contribute from a profit sharing standpoint. How does an actuary kind of differentiate the duties of an actuary differentiate from, say, a TPA?
Well, it's just they need to run the calculations, and without getting too far out in the weeds, we define the benefit as some future benefit, and then how much do we need to contribute today with a 4 to 5% rate of return, compounded growth, et cetera, so that we can hit that future benefit. So there is an actuarial formula that goes into the contribution amount each year, and that's why we need an actuary. And
Okay.
because of the size of the tax deductions here, right? Not 70,000, but 270,000. The IRS scrutinizes these plans a lot more than their 401k plan cousins. So there's additional documents that need to go in every year with the IRS Form 5500 that have to be signed by a licensed actuary.
So any old TPA doesn't necessarily have the expertise to make sure that cash balance plans are in compliance, even though they're doing their calculations and evaluations for 401k plans. And basically, generally, you should probably work with a firm that's got a specific group that has expertise and focus on a cash balance plan. Could you expand on that a little bit and the capabilities of your firm?
Yeah, I think the simplest answer is we have 60 actuaries on staff.
Uh-huh.
They're our W-2 employees, and we control the workflow. And so that gives us an advantage over many of my competitors who don't have an actuary on staff. They use an independent, 1099 actuary contractor, for example, and that's not an employee of the third party administrator. So they can't necessarily control the workflow when that actuary is working with 10 other local third party administrators. So it
Yeah.
gives us a competitive advantage. We've also been writing cash balance and traditional defined benefit plans for over 30 years. And we write approximately 1 out of every 5 cash balance plans written is written by Future Plan.
Well, in reality, what happens a lot is these cash balance plans are deployed and integrated with 401k plans. And one thing I've found, if the left hand isn't talking to the right hand with regard to, what to contribute on both sides, it can be just a burden for me as an advisor and the my clients, the business owners, and we like to see that expertise in house. And once again, the left hand talking to the left hand or right hand. Well, Nate, I hope. Well, I'm glad you were able to join us. Again, we just kind of went over the differences between a 401k and a cash balance plan. We'll continue this series on cash balance plans. Nate, very much appreciate having you on. We'll see you again in the future, and thanks for bringing your expertise and insight. Again, for those of you who are interested, my name is Morgan Smith, partner advisor at WorthPoint. We can be found at worthpointinvest.com. There's my email. Nate DeLong is a certified pension consultant with Future Plan. His email is there, nate.delong@futureplan.com. You can contact any one of us. Let us know that you saw the video and let us know if you've got any questions and like to look at cash balance plans. On that note, take care and have a great day.